The early 2000s saw a dangerous cocktail brewing in the U.S. financial system. Easy credit conditions, fueled by low interest rates, created a housing bubble. Banks, eager to cash in, lowered lending standards, offering mortgages to borrowers with poor credit history. These subprime mortgages, packaged and sold as securities, became ticking time bombs. Financial deregulation, a trend that had been building for decades, further fanned the flames. It allowed financial institutions to take on more risk, believing that complex financial instruments had eliminated it altogether. The stage was set for a financial crisis of unprecedented proportions. The housing bubble couldn't last forever. As interest rates began to rise, many subprime borrowers found themselves unable to make their mortgage payments. Defaults mounted, and the value of mortgage-backed securities started to plummet. The intricate web of financial instruments, once touted for its sophistication, quickly unraveled. The system, built on the assumption of ever-rising house prices, was ill-equipped for a downturn. Panic spread through the financial system as institutions realized the extent of their exposure to these toxic assets. The collapse of Lehman Brothers, a venerable investment bank, in September 2008, sent shockwaves through the global financial system. The event, once unthinkable, exposed the fragility of the interconnected financial world. Lehman's failure triggered a cascade of events. Banks, fearing further losses and counterparty risk, became reluctant to lend to each other. Credit markets froze, threatening to bring the global economy to a standstill. Governments around the world were forced to take unprecedented action to avert a complete meltdown. Section 4, Shockwaves and Aftershocks, a global financial earthquake. The immediate impact of the crisis was felt most acutely in the financial sector. Banks collapsed, were forced into mergers, or received massive government bailouts. The stock market crashed, wiping out trillions of dollars in wealth. But the pain wasn't limited to Wall Street. The crisis quickly spread to the real economy, leading to a severe global recession. Businesses struggled to obtain credit, leading to layoffs and investment cuts. Consumer spending plummeted as uncertainty and fear gripped the world. Section 5, Main Street's pain from Wall Street's mistakes. The human toll of the financial crisis was profound. Millions of people lost their jobs, homes, and life savings. The unemployment rate soared, reaching levels not seen since the Great Depression. The crisis exposed deep flaws in the financial system and highlighted the devastating consequences of reckless lending practices and inadequate regulation. It left many questioning the fairness of a system where those responsible for the crisis seemed to escape unscathed, while ordinary people bore the brunt of the pain. Section 6. Picking up the pieces, Aftermath and Lessons Learned. In the aftermath of the crisis, governments around the world implemented a range of measures to stabilize the financial system and prevent a repeat of the disaster. These included massive bailouts of financial institutions, stricter financial regulations, and increased oversight of the financial industry. The 2008 financial crisis serves as a stark reminder of the interconnectedness of the global economy and the importance of sound financial regulation. It's a lesson we can't afford to forget. Stay informed, ask questions, and demand transparency from our financial institutions. The future of our economy depends on it.